Is it too late to be getting into the equity markets if you're already not invested? What can historical patterns tell us about where valuations may go from these levels already? And what are the preferred sectors by our next guest, Chance Finucane, CIO of Oxbow Advisors? Welcome back to the show, Chance. Always good to see you.
Great to see you too, David. It's great to be back.
Let's start with valuations. You're telling me offline about a research project you were working on, which shows historical patterns of how valuations have evolved over time and whether or not this can indicate to you waiting, getting in now, or potentially even selling. Tell us about that.
Sure. So what we were looking at is, as of this week, the S&P 500, its forward price to earnings ratio is trading at 20 times, which does not happen very often. The average is usually about 16 times over past decades. And we wanted to look at, for anyone who's thinking about trying to chase and buy in at these prices, does it tend to stay at this level for 5 or 10 years? And when we look back a century of data, there's never been a case where valuations stayed above the average of 16 times for 5 consecutive years when your starting point was this 20 times number that we're at today. And a good example of this is at the beginning of 1998, in the middle of the dot-com bubble, we got to 20 times forward earnings in the S&P 500. And obviously we had 2 more years running higher in that bubble, and you felt like you were missing out if you weren't owning all those crazy tech stocks. But if you looked at the total return of the major indices like the S&P 500, the NASDAQ 100, or the NASDAQ Composite, from the start of 1998 to the start of 2003, there was 0 total return, and actually even a little bit of a decline in the NASDAQ Composite over those 5 years. And so when we compare that to the current risk-free rate, where you can get a 3-month treasury annual return of over 5%, we're okay being patient and really holding to our metrics of when we want to buy something and at what price, rather than feeling that we have to jump in at these prices.
I want to ask you about why you think valuations may be an indicator of what you should do. I've heard that valuations are possibly one of the worst indicators of price movements. Would you agree or disagree with that statement?
It's not a great indicator of price movement in the short term. So there's not a lot of correlation between starting valuation and what the market's going to do in the next 12 months. The market can go in any direction it wants to, depending on how much greed or fear investors are feeling at that time. But when you stretch out your time horizon, and we're usually looking at stock investments looking out 5 years, over a 5 or 10 year time horizon, the starting valuation absolutely matters. And so from what we're just saying here, if you're starting at 20 times earnings and thinking that within the next 5 years, it's going to come back to 16 times earnings, that's a 20 to 25% decline just baked in already that you then have to overcome with earnings growth. And we're not starting at trough earnings. Right now, it seems like people are expecting anywhere from 8 to 11% earnings per share growth in 2024 and 2025. We'll see if that actually happens. But even if it does, that plus the valuation compression, you're only looking at probably a 3 to 5% annual return in the major stock indexes over the next several years, which just doesn't seem like worth taking the risk unless you can find individual stocks trading at great valuations.
How would you respond to the argument that the S&P 500 has over time become more and more tech heavy? And so what we see now is perhaps an expansion of overall PE because these tech companies have higher PEs than perhaps other industries. And so if we consider that, one could make the argument that the S&P is actually fairly, if not undervalued, compared to just the tech sector overall. Would you agree or disagree with that?
I understand the point that, we have higher quality businesses that represent a greater concentration of the market today, and therefore they should trade at higher valuations. If we just look at the last 10 years, the average price to earnings ratio of the market is 17 times. And that really encapsulates this period where tech has become a much bigger factor. The other thing you have to remember with tech, though, is when tech businesses stop showing that double-digit growth, especially in revenue growth, which is the big driver of tech valuations, when you see them slow down to only growing about the same rate as the overall economy, those valuation multiples compress really quickly. And so right now you have the top 6 or 7 stocks in the market take away Alphabet because that trades at a pretty good free cash flow yield. The other big 6 names, Amazon, Tesla, Meta, Apple, and Microsoft, those types of names are trading at 40 times free cash flow. That's just not sustainable. And typically everything's going to come back to 30 times or less in a free cash flow or an earnings multiple as the growth slows or competition increases. And that's going to act as a headwind for a market-based index like the S&P 500 in the years to come.
So what's more likely to happen? So you got two sides of the PE equation. You've got price and you've got earnings. Will price move down? Will earnings improve if we were to see either an expansion of PE or a continuation of current levels?
Well, even if you get, let's say, like next year, we're expecting 10% earnings per share growth. At least that's what the market expects. If you just look at consensus expectations, that's still only going to reduce this 20 times forward number down to 18 or 19 if you fast forward 6 months or 12 months. So you're still trading at above average valuations, and you don't have this earnings acceleration because you've still got monetary tightening happening around the world, and rates are going to stay high. One other factor to consider with the earnings per share growth, we just went through a period of the last 30 or 40 years where we've seen numbers that 40% of the growth in earnings per share was carried by tailwinds in interest expense because we had interest rates declining since 1981 and lower tax rates. Those two tailwinds are gone. So you really are just relying on nominal GDP growth, so revenue growth, and maybe they can expand their margins a little bit, but we're still at a pretty high profit margin level across different industries. So you're looking at maybe 4 or 5% profit growth, maybe a little bit of share buybacks. It's probably like a 6% earnings per share growth that you would expect in the years to come for the overall market.
Okay. I do want to come back to your macro outlook, but first let's talk about your sector bias, and then we'll discuss the rationale behind your picks. So which sectors do you like the most right now?
Right now, we like the defensive sectors. At the start of this year, the majority of positions that we own in our stock portfolios were actually in the tech and consumer discretionary area, but those have performed so well in the first 7 months of this year that none of them really look that undervalued at this point. So you really want to shift and see where is the relative value. And when you look at defensive sectors, you often want to look at their relative price to earnings multiple versus the market multiple. They tend to trade in a pretty consistent range on a relative basis. And so what we're seeing is there's numerous healthcare and consumer staples and even utilities names that are trading at 10-year lows on a relative price to earnings basis. So in recent months, we've especially been purchasing health insurance businesses, which there is some concern about medical loss ratios going higher, but recent earnings reports have showed that that's not as bad as was feared. We're also looking at some of the pharmaceutical businesses that are trading at lower valuations, but still generate lots of free cash flow. And you're starting to see some of the consumer staples names pull back, although they're not quite at the level yet that we'd feel like they're an absolute value and we'd start really adding them.
And do you think that from a valuation basis, these defensive sectors are fairly valued?
They're somewhat undervalued on an absolute basis. When you're thinking about defensive, when is the right time to own defensive sectors? It tends to be around this point in the cycle where the overall market multiple is near its high, and these are trading somewhat undervalued on an absolute basis, but they're really trading cheaply on a relative basis. And they typically will kind of hold their ground because there's a lot of visibility and stability in their cash flows through the economic cycle. But typically, if you're trying to buy this at the absolute cheapest absolute multiple that you could find, it likely means that the overall market has declined by a lot and you're better served investing in other cyclical sectors. So you're kind of playing a balancing game, but in terms of managing the whole portfolio, now is the time to really look in those defensive areas.
What's the dividend yield on some of these defensive plays compared to other sectors?
It depends on what you're looking at and the style of the business. So the health insurance businesses, those dividend yields are lower, maybe 1 or 2%. But some of the pharmaceutical companies have a 4% yield or higher. And so those are areas that we might look to really put those in some of our income investors' portfolios. If you're looking for a much higher yield than that, we're really setting a bar of looking for a 6% dividend yield or greater to try and eclipse that 5.4% yield in the short-term treasury. And that 6% yield or higher, you're finding in some high quality REITs, as well as some of the oil pipelines that have been performing well in recent months, but were providing us some great valuations at different times in the first half of the year.
Okay, so if I were to make the overall assessment that right now it's too expensive to be jumping into the markets, the overall index, if you were to just to buy the S&P 500 index, and it's probably better to wait for a pullback in valuations like you mentioned, but there may be opportunities in certain sectors that are undervalued. Would you agree with that assessment?
Yeah, that's exactly right. That example I pointed out of those 6 of those very large tech companies trading at 40 times free cash flow, we think you can find names trading at 14 or 15 times free cash flow or even 10 times free cash flow that are great entry points and might have a lot more stability in terms of their cash flow generation, even if there is an economic slowdown. So those are the areas that we think we're looking at more at this time.
Let me make a counter argument to the tech stocks being vulnerable during a recession, which we've seen during the dot-com bubble and even 2008. Now, this time is a little bit different, some may argue, because these bigger companies trading at 40 times cash flow, they're actually making cash flow, like in 2001. And in fact, you could go as far as to argue that perhaps these bigger, larger names, the FANG stocks, the blue chip tech companies, are the new utilities companies, because during a recession, what happens is people cut back on discretionary spending on leisure and entertainment and travel and whatnot, but they're not going to automatically cut down on their subscriptions to Microsoft Office or an Instagram account if you have a blue check mark, whatever the case may be. It's out of habit and it doesn't really cost that much. And so their subscription model is baked in to their valuations, and that's pretty stable even during an economic downturn. How would you respond to that?
Yeah, you're right in that there is a lot of consistency to their cash flow generation. Those subscription models are very attractive. And some of the names you mentioned or you're sort of alluding to, we own those. We've owned Microsoft for many years. We've owned Adobe for years that generates a lot of subscription revenue. ServiceNow is another one. All I'm really trying to say is these stocks were cheaper and we were buying them for new clients' equity portfolios in the fourth quarter of last year. But after they've all gone up by 50% or more, now you got to be more cautious in terms of when you want to add. And we don't know how long this run higher will go. Greed can sometimes last longer and push further than you'd ever anticipate. But we have to have a discipline in terms of what price we're willing to pay and when we want to stop and wait and see if we can get a better valuation. So you're right that the earnings and the free cash flow generation is impressive. They have great balance sheets, but we're keeping those positions smaller and we're seeing if there's going to be a better entry point anytime in the next year.
Now, we've talked about undervalued sectors. What, in your opinion, are the most overvalued sectors? Is it tech? Something else?
It would be tech right now if we're looking at our metrics. Consumer discretionary has some other examples like that. And then one more that actually surprises us a bit would be the industrial sector, which still, we saw somewhat of a pullback in financials and in energy and even a bit in materials, but industrials has still held up well. And those are some high quality businesses, but they still have cyclical earnings. And we would expect if we have a recession sometime in the next year or two, that would be a headwind for them in terms of their earnings over the next 12 to 18 months. And you would see those share prices pull back.
Okay, so the underlying assumption is a recession in the next year or two. So you do have a slide here on sector attractiveness, which I'll show on the screen. And like you mentioned, avoid energy, financials, industrials, materials, ex-gold, and discretionary retailers. So this leads me to my question about your macro thesis. You are avoiding these sectors, I'm assuming, because you see an economic downturn on the horizon. Is that correct, Chance?
Yeah, that's correct. We've been following this, and it takes a long time to play out. I think what everyone forgets is that monetary policy, especially like when the Federal Reserve and these other central banks are raising policy rates, that can take over a year for it to cycle through and start to affect consumption by everyday consumers and start to slow down other industrial activity. But we're right now starting to hit that point where we're 16 months since that first rate hike in March of last year by the Federal Reserve. So we would expect to see that deceleration in growth continue. and think that we're headed into a recession. And that's why we have this caution with some of these more traditional cyclical areas.
Okay. How do you think monetary policy will play out now? Let's talk about the Federal Reserve before we discuss other central banks. Do you think the Fed will stick to their projected or telegraphed, however you want to call it, 2 more rate hikes by the end of the year?
I think everyone's in agreement that they're going to raise rates another 25 basis points next week. After that, we'll see what they decide to do in the last 4 months of the year. One thing that maybe just for everyone to know is this inflation number, the CPI that just got printed earlier this month of 3% year over year inflation, that might be the low number in that metric for the rest of the calendar year. And if we have numbers where they start moving higher up towards 3.5% again out through December, that's going to make it a tough position for Fed Chairman Powell to not consider hiking rates again, because he really needs to see the CPI get down to 2% and see that core PCE number that's at 4.7% still get down at least below 3.5 or 3, below all the different treasury yields, before he can start to say that he's accomplished his mission of fighting inflation.
What happens if a recession comes, which is to say that unemployment rises before the core PCE drops down to close to 2%? Do you think the Fed will still hike then?
We think they're really focused on inflation. More than half of the households in the United States have less than $10,000 in savings. Higher inflation affects all of those households, all U.S. citizens. And I think their view on it is we need to preserve our credibility. We need to get inflation back to our normal level. And if that increases the unemployment rate by, they're saying, I think 1% in their projections, then I think they would accept that if they can get things back to a more normal level.
So let's talk about the consumer now. So you've got a slide here showing mortgage payments versus incomes. And the blue line showing median monthly after-tax incomes steadily rising, and then the median monthly mortgage payments shot up dramatically over the last year and a half. It's now, well, it was briefly above the monthly after-tax income, which is crazy. How did people even finance that? But now it's on a national average, I guess, on almost on par. This is going to put considerable strain on the consumer, of course.
Yeah, so that chart it shows, and it's 2 different scales. So the median monthly income, basically what you had is the mortgage payment has doubled in 3 years. If someone was taking out a new mortgage today to buy a new home at a 7% mortgage rate, they're paying double the monthly payment that someone did in the middle of 2020 when you could get a mortgage rate below 3%. And what's really important is it's nearly 50% of the median U.S. households after-tax income that is going to that mortgage payment if they're buying a house today. That's really difficult to have any savings to really push that into any sort of additional consumption that would help the economy. But one big takeaway from this is why there are so few existing homes for sale on the market. You've got 80% of current homeowners have a mortgage rate right now that's below 5%. And thankfully for U.S. citizens, those are long-term fixed-rate mortgages, unlike other countries we see like the UK and Australia, where the mortgage rates reset every 5 years. That's a much bigger problem. At least if you bought your house at a much lower mortgage rate, you get to keep that rate for the entirety of the loan. But no one wants to move and pay a high home price at a much higher mortgage rate unless they absolutely have to. And that's why we're seeing such low existing inventory. And it's been a great deal for the home builders because they are now 25% of the homes for sale are the brand new homes, compared to usually it's about 10 or 15% historically. So it's been an unexpectedly great environment for them. One thing that we're considering is that if you did at some point see a drop in mortgage rates, if there was a drop in treasury yields in the future, that might lead to a surge in existing inventory, and that might cause a delayed drop in home prices. But right now, with so few homes for sale and low inventory, it's keeping the home price relatively high.
Interesting. So a drop in rates actually could, in the short term, be negative for home prices. That's an interesting dynamic. People are always wondering when mortgage rates can go back down to historical averages. Is this possible in the next 1-2 years?
It's hard to say the exact timing, although given our economic outlook that we think we're heading into a recession, we think that would drive mortgage rates lower. So there's two factors to consider here. The 30-year fixed mortgage rate is often compared to the 10-year treasury rate. And right now, that relationship is a little bit skewed. There's so much volatility in interest rates right now that the companies that are offering the loans are actually charging a higher mortgage rate by about 1% than they would normally. So right now, the 10-year treasury rate is a little below 4%. Normally, that would mean that the mortgage rate would be a little above 6%. Instead, it's a little bit above 7% today because they're factoring in for that high volatility. But if you had a more normalization of interest rate volatility, and if you have a recession, which typically drives the 10-year and 30-year treasury yields down by about 1.5%, you could see a return to a mortgage rate back towards 4 to 5%. And maybe that leads more families to want to move. And really what drives home prices is going to be how much inventory there is available. So if there's a spike in inventory, because that might be during a period of economic weakness, that's why we say that could lead to some weakness in home prices.
So finally, I want to talk about actions that Oxbow Advisors is taking in light of the discussion we've had so far on the economy. You have another slide here called decline required to reach targeted buy price. And so some of these sectors we've already talked about, the tech industry, for example, e-commerce, you're looking at a decline by 35% to reach a targeted buy price. So I'm assuming then, just based on this, and by the way, all sectors need to decline across the board before you reach buy signals. Are you then just waiting on the sidelines then for a correction, or are you adding more to, I guess, the less overvalued sectors right now?
Yeah, so the way that we view it is we have an estimation of what we think each company's that we track, and we track several hundred stocks. We have an estimation of what we think the fair value of each of those stocks is, but then we also have put in a significant discount to that fair value estimate for each stock. That would be the price that we would want to see to be able to buy. And that discount varies. So if it's a very stable, steady business with little fluctuation through an economic cycle like Coca-Cola or Pepsi, we might only need a 10 or 15% discount because it trades in a narrow trading range to say, all right, that's enough of a discount for us to want to add it into our client stock portfolios. But for something that's a lot more cyclical and has a lot of fluctuation in their cash flows, which could be like a semiconductor business or an e-commerce business, we might want something more like a 30 or 40% discount before we would move in. So what that chart shows is because some of those tech sectors, the average stock is trading 5 or 10% above fair value, if we want to buy at a 30% discount to our fair value estimate, it's got to come down by 30 or 40% before it would hit our levels that we'd want to buy. But to your point, there are some of those defensive stocks that we cover that hit really low valuations, lowest we've seen in 10 years. And we were able to buy in the last handful of months at 10 times earnings, 11 times earnings. And so if something hits our price point and we still like all the fundamentals of the business and we think the cash flows will be steady and consistent through what we think will be a difficult environment, we won't hesitate to add. And that's how we've been buying over the last several months.
And what's your view on fixed income? Are you short duration, long duration?
Vast majority is short duration. I'd say it's almost probably a 5-to-1 ratio in terms of short-term treasury. That 5.4% yield that you can get annually out to a one-year treasury is pretty attractive. It's been a long time since we've had something like that available to an investor. But we do still have a little bit of exposure to the 20 to 30-year treasury just because when the Fed stops tightening, and we don't know if next week's rate hike will be the last one in this cycle, or maybe they raise rates 1 or 2 more times later in the year. But probably at some point by the end of this year, they'll be done raising rates. Whenever that happens, there's a good track record of long-term treasury bonds increasing in price and seeing its yields go down, which can generate anywhere from a 10 to 15% return to the investor over the next 12 to 18 months after the Fed tightening cycle is over. So once this last rate hike is in and they stay flat for a while, we think that's a good time to make sure you own some long-term treasuries.
Okay. And what's your view on corporate debt right now and yields on corporate debt? Is that a sector that you would be looking into?
we really only look in that sector when you see the spreads between the yields on corporate debt, whether that's investment grade or junk debt, versus whatever the treasury yield is. We need to see those spreads widen. And what's kind of amazing to us is that despite the increases in loan delinquencies and some other activity like that, the spreads between corporate bond yields and treasury yields are actually below the long-term average. It's signaling that there's a lot of economic strength out there. And the only reason we can really come up for that is that because in 2020, the U.S. government basically, they went in and bought ETFs of corporate bonds. And maybe people are banking on that kind of stimulus again in the future, the next time we have economic weakness. And therefore, they're not acting quite the same way as they would historically at this point in the cycle.
How do you feel about owning a REIT or residential real estate and collecting rental income?
Are you talking about just personally, like a private investment, or one?
Oh, well, I guess both. But I was talking specifically about adding to the high income portfolio using real estate.
Yeah, I think it just pays to be very careful about which subsector you're choosing. So even though, for instance, some of these office REITs might look like they have high dividend yields, we're just continuing to see data points that the world has changed for how everyone works. There's more of this hybrid environment, and we're still only at a back to the office rate of about 51% is the most recent data point that I saw compared to where we were in 2019. So certain subsectors like that, we don't want to jump in. What we're looking for are the REITs that are going to have pretty consistent cash flow through any sort of fluctuations that we have. And we found a few like that, but when we're trying to find at least a 6% yield, there are not that many out there. So we're kind of just picking our spots, but we wouldn't say broadly just buy real estate.
And finally, gold. We've seen gold move up this year, breached $2,000 briefly, actually more than once. Is the current price enticing for you to add more?
It's a decent spot right now. So trading, I think, about $19.70 per ounce. When it got above 2,000, we paused all of our buying for any new accounts that joined us. When it got down to the lower 1900s a little bit ago, that was when we were adding. We own a few gold-related stocks and then also have an allocation to a gold ETF and really filled out those positions. So it's just being mindful of the valuation you're paying. I'd say the gold-related stocks are trading somewhat undervalued, but they could definitely get cheaper. So we're probably only maybe a little more than half buying into what our full allocation would be if a new account was joining us today.
Overall, then, are you constructive on gold given your outlook on the economy?
Yes, we are. I think it helps to have anywhere from, say, a 2 to a 10% allocation to that area, depending on what your overall strategy is. But gold tends to hold up well through a cycle. Obviously, it's going to move in its own way. Right now, with real interest rates, so just taking the 3-month treasury of above 5% minus the 3% CPI, you've got over a 2% real interest rate, which is not the best environment for gold. But if you see some sort of a cut in interest rates down the road, we expect gold to kind of hold its own until then, and then maybe you get a pop once you get back towards 0% real rates in the future.
Okay, excellent. Chance, where can we learn more about your work at Oxbow Advisors?
Yeah, you can learn more about our work at oxbowadvisors.com, as well as our Oxbow Advisors channel on YouTube.
Excellent. I'll put the links down in the description below. Thank you very much for your time today. Thank you for coming back to the show, and enjoy the rest of your summer. We'll speak again soon.
Yeah, thanks a lot, David.
Thank you for watching. Don't forget to subscribe.
We like to provide the information we think is most valuable for investors. If you'd like to see more videos like this, please subscribe to our YouTube channel.